Welcome to CAS Direct. Before we begin, I'd just like to make a note that any advice is of a general nature only, and yet your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton from CAS Direct. In this webinar, I'd like to talk about bullish and bearish technical divergence. Bullish and bearish technical divergence can help identify market reversals in stocks or even foreign exchange. We consider divergence as a powerful signal. Divergence appears when a technical indicator, usually an oscillator, begins to establish a trend that disagrees with the actual price movement. Sometimes a technical indicator will disagree with the actual price direction of the stock you are assessing. These disagreements are strong signals and somewhat useful for the trader. Price goes down, and as you can see, the histogram with the MACD is going up. Also with the RSI or stochastic is going up. So when the price is actually going down, the indicators are actually doing the reversal. Here is another example. So first of all, prices are making lower lows. So as the price is in a downtrend, and we are seeing lower lows being slowly posted, is that you can look at the oscillator, and that's actually rising. So it's doing the opposite of what the price is doing. And therefore, this is bullish divergence. And eventually the market will turn around and snap to the upside. So let's look at it in the opposite way. When prices are making higher highs, and as you can see here, continuation entry. But when the oscillator is making lower lows, then therefore, this is bearish divergence. So when the market's in an uptrend and the oscillator is starting to post lower lows, as you can see, eventually this is where the market will turn and snap to the downside. Divergence can be a significant warning signal that a bullish or bearish trend is coming near to an end. Divergence appears when a technical indicator, oscillator, begins to establish a trend that disagrees with the actual price. So let's take a little look further into this. I use a MACD, which is a moving average convergence divergence oscillator. It's quite a powerful signal when you do see divergence. So let's explain a little bit more. On a trading chart, the moving average convergence divergence indicator, also MACD, was designed by using an exponential moving average of 26 and 12 days, although you can define these numbers if trading different time frames, as in if you're going to shorten it down from weekly to dailies, so maybe look at the time frame of 4 hours to 1 hour. It consists of a MAC line, a signal line, and a histogram. But more importantly to watch is the MACD histogram. The purpose of the MACD indicator is to show changes in the strength, momentum, and direction of the current market. This is what a MACD looks like. So as you can see, we have the histogram, and also we have the MACD line and the signal line. So what happens is if you follow these lines, the MAC line cuts over the signal line to give you a bullish signal, and when it cuts to the downside, it gives you a bearish signal. The MACD turns two trend indicators, an exponential moving average, into a momentum oscillator. As a result, the MACD offers the best of both worlds, a trend following momentum indicator. I would like to just explain a little bit more the construction of the MACD. So here you have the MACD line and the signal line and the histogram. Because the MACD is unlimited, it is not particularly useful for identifying markets that are overbought and oversold. When you measure the inside of the MAC line and also the signal line, you can see that the histogram actually portrays the inside of the height and low. This is how the histogram works. The histogram equal distance between the MACD and the signal line. Therefore, when the market moves, the MACD line and the signal line follow in a pattern, the histogram either expands or decreases. In the first instance, let's look at a currency. Now, as you can see, that bullish divergence was evident around the 16th of June. As the market price went down, the indicator was clearly going up. A buy signal was generated when the histogram breaks over the zero axis. As you can see from the far right, is that we got a buy signal from the histogram as it breaks above the line. And therefore, the price action responds quite bullish from the divergence. But if you haven't quite caught that, you can see the pattern a little bit further actually repeats itself. So let's get to that now. We did get a signal bearish reversal when the currency got to a point of an exhaustion pattern and turned around. And then the market started to decline. And then from the price selling off, as you can see here in two instances, first of all in late July, and then secondly in August around the 15th, is that the indicator all that time was advancing or climbing. To a point from the bullish divergence, is the market once again triggers a buy signal as it breaks above the zero axis. Therefore, the market actually responds quite aggressively from moving around from 100 up to around 104. And then, of course, the market starts to sell off again. So let's look at some stocks that actually have bullish and bearish divergence. So let's start off with two stocks. One, I would like to use the MACD, and then I would like to use an RSI, which is a relative strength index, just to show you the comparisons between the two indicators. Now, looking at Cogstate, the code is CGS, we can see that the market was pretty much coasting with a cap at 95 and looking for a potential downturn earlier this year. And as you can see, with the market falling just beneath 80 cents and close to a 75-cent low, is that the first point of the price is the indicator bottomed out. Secondly, the market retraced back to 90 and then sold off again to 75, but the indicator was rising. And you can see here in this instance and also in this instance is that the indicator was clearly showing bullish divergence as the price was declining. And therefore, from 75 cents, the fact is the market rallied, cut through the zero axis and gave us a buy signal and went on to around 94 cents. Now, the next market I'm going to look at is using an RSI, QBE Insurance Group Limited. Now, as you can see, the price action from November was coasting pretty much in a $10.60 to $11.20 range. We had a very sharp fall in January 2018 down towards the region of 90.80 and then recovered quite impressively to $11. And then after that, the market pulled back again to $10.20 and went up to $10.80. Now, as you can see from then, is that the market sold off from $10.80 to a low of $9.40. But if you have a look inside the March price action, is the price was going down all the way from $9.80 to $9.40. But the indicator was going climbing and climbing and climbing. And as you can see from there, the market eventually snapped to the upside because as the price was going down, bullish divergence was clearly evident. And the call from this kind of price pattern is that the market will eventually reverse. And as you can see, it did exactly that and snapped to the upside from $9.40 and rallied all the way. And at this point, it's looking towards the level of $10.20. So our conclusion is that divergence is one of the most powerful tools of fundamental analysis and is key in CASDirect's market assessments. Constant and through monitoring of financial markets is an effective way of identifying opportunities such as divergence. Each week, our experienced research team analyse thousands of stocks for you to deliver concise and actionable calls. Once an opportunity has been identified by our analyst team, it is then added to our weekly stock picks, which can be found on our stock picks page, alongside our daily research reports. The picks come with our detailed recommendations and CASDirect's outlook on potential pricing movements. So that wraps up this tutorial webinar on technical divergence, but please look out for further educational tutorials in the coming future.